Hey everyone, I'm Jessica Kang. I am the pipeline manager at Techstars. You may have seen me at a previous event or received an event invite from me, but we host these events every week for our founders. So my role at Techstars, along with my colleague Karina here, we help to find the greatest startups in the world to join our accelerator programs. So hopefully you gain a lot of information from Naji today, and maybe you're interested in applying to Techstars. But we will share this recording with you after the event is over for those who have registered. So Naji, over to you.
Awesome. Well, thank you guys for joining me. As Jessica mentioned, part of the Techstars team. I'm the investment associate for two programs in Silicon Valley, both the Techstars Oakland Powered by JP Morgan program and the Future of E-Commerce Powered by eBay program. Vastly different theses and everything like that. Unfortunately, it's also too late to apply right now for either of the programs. Applications closed July 5th, but I think the next round of applications for the Oakland Powered by JP Morgan program are going to open up in September. So if you're interested in applying and you really enjoy hearing my voice, please do so, and we'll take a good look at your application and consider you for that program. But today, and apologize for my low energy, I'm a little bit tired today, but what we're going to be talking about today is your startup investable? Kind of the main question at hand. And I have a somewhat of a novel answer to that question that I hope will challenge you guys to maybe answer this question yourself, because I think it's an important one for founders to be doing themselves. So I guess, I don't know, Jessica, if I need to say anything else, but otherwise I can just hop right in and we can get to the question and answer period a little faster.
Yeah, I just wanted to add, if you have any questions, please utilize the Q&A button so that way we can keep track of your questions. But after that, you're all set. So go ahead, Naji.
Awesome. Okay. So let me go ahead and share my screen. I have a little presentation for you guys. And then, awesome. Awesome. So I hope everyone can see my screen now. I am trying to do something, but this is not letting me. Hold on one second. Okay. There we go. Sorry about that. Let me start the slideshow. Awesome. Okay, so basically want to talk about and help you guys kind of figure out, is your startup investable, but really what it means to identify the right kind of capital for your startup. And in a lot of ways, this question is pretty easy to answer. I think for I hate to be like a little bit pedantic, but does your business make money? If your business makes money, or it's something that you see a logical path to making money, the short answer to your question of is your business investable? It's probably yes. The easiest, the kind of the dumbed down version of the talk is basically just alluding to the idea that like investors are here to make money. That is their job. So if your business is doing that, then it's something that they can potentially invest in and make some money. But I think the real conversation gets a little bit more nuanced than that, because I'm sure a lot of people, especially if you've been raising capital or if you've been applying to different programs or trying to speak to investors, a lot of the time they're probably like, no, or this isn't a fit, or this isn't a venture backable business, for example, is probably some of the answers and responses you hear. And that is for good reason. But they are in a lot of ways like speaking a different language. So I kind of want to like break that down for you guys today and sort of help you navigate that landscape yourself and understand what's kind of the right capital for you. So I think typically what we're going to be talking about today. I think the key concepts here are just like understanding your business, because to understand whether or not your business is investable, you really need to have an idea of like not only what your business does and the market you're attacking and the size of it and all of those good things, but also like more so just what you want out of your business. You as like a founder, as an individual, where are you hoping to go? Where are you, like, how far are you planning to really take this? How long do you really want to be a CEO and work on a project like this? The second question or part of the talk is we're going to talk about understanding your investors. Most people see investors as kind of like this, like, this big stop as far as like the capital, and that's like the final place that they are really like pitching to. But the thing that most people need to understand is that investors are kind of running their own startups in a sense. They have investors in the same way that you're looking for investors, and they have to look for investors pretty much in the same way that you're looking for investors. And so understanding that, you'll be able to help kind of better identify their profile and understand whether or not they even want to talk to you, and if your business makes sense for their business, if you're the right kind of customer for them. And then we want to break that down a little bit further and get into like the types of capital that are available, because there are a wide variety. A lot of people often think it's just venture capital because they hear that word a lot. Venture VCs they love to be on Twitter and they're promoting themselves and talking about things, but there's a whole host of other places you can get capital from, and there are advantages and risks associated with that. And then the last piece we'll talk about is like the narrative, which a lot of people, I think, more and more are beginning to realize that like how important this narrative is, but ultimately, kind of ripping off of Simon Sinek, it all starts with why. And like, why does your business align with this investor? What is the story you're telling? Where are you going? And so I want to start this conversation off just by kind of like gauging the audience. So I hope you'll indulge me at least. I'm going to submit a poll. So kind of the first question to start with in terms of like understanding your business, I think it's really important, as I said, to like understand where you're trying to go. So I'm going to ask you guys a question here, and I'll give you a second to respond. So first question is, how much annual revenue, I kind of wanted to simplify it in terms of magnitudes, do you realistically see the business getting to, your business right now? I'll give you, I don't know, 30 seconds to kind of answer. I'll wait till I see at least like 50% or something response. Awesome. Oh, wow. I'll leave more people to vote. You guys are actually active on here. This is exciting. So what I'm seeing, honestly, like I could pretty much stop it right here. It's pretty interesting to see this already. But I think, is there a way, if I end this poll, Jessica, will it just show for everyone, or is it showing right now? I can't tell if everyone can see this.
Oh yeah, it was already showing, so.
Oh, okay, perfect. So ending the poll, very interesting responses. It's almost like broken down fairly evenly, about a quarter of you kind of answering this question. And I think, as I was alluding to, like talking about this, and we'll come back to this later, but if you pretty much answered anything besides, I would say, the final answer, which is $100 million, you're probably not looking for venture capital or private equity. And I'm just going to be honest with you there. If you're building a business and you're hoping that the annual revenue will get somewhere between like 1 and 10 million by kind of like by the exit, or that's like sort of your ceiling, venture capital is probably not the right place. And for the most part, you're probably going to hear no's. And that's because that amount is just not large enough for most people to return their fund, which is really one of the key concepts to understand about the way that VCs see this world. there are other, as I alluded to, there are other kinds of capital. There are other people who are looking for other kinds of investments, though. So it doesn't mean that your business is bad. Like making $1 million in annual revenue, that's extremely exciting, but that doesn't necessarily mean that certain capital is the right ones for you. And so let me,
we had
go
a
ahead.
question too for when the poll was up. So what is the time frame of this? Is this like, how many years are you expecting to reach this until you reach this annual revenue?
I'm thinking like, what do you expect the business to get to? And I'm going to get to the kind of the time frame in a second as well. That's one of the next questions. But so we can jump to that one if you'd like right now. So this one is, what is your timeline to profitability? How quickly are you hoping to get to that number, that you are a successful business and likely looking towards kind of an exit? Okay. So this one's I think this one's a little bit more balanced. You guys are maybe catching on to my trick questions a little bit. But basically, if you answered 5, I would say the 1 to 5 year options are pretty much the ones that you should be thinking about if you're looking at venture capital. This is money that is meant to be invested, and you're meant to grow the business very quickly. Typically, funds run for about, I would say the life of a fund is usually around 10 years maximum. And ideally, you're starting to like close out the fund by, I don't know, year 5 and 7. Between years 5 and 7, you're hoping that you're going to start paying back your investors as a venture capitalist. And anything longer than that, you're probably looking again at a different kind of investor, someone who has a lot more appetite for longer term investments, something closer to the likes of like real estate. But when it comes to these kinds of businesses, because they're so high risk, it's not typically something that you want to see like a long time horizon on. So for those of you that answered for the top 2 answers, I would say you're most right. 5 to 10, you could still be there. There are funds that are a little bit more impact driven, are a little bit more patient capital. So that would fit, but the 10 plus years, that was only really one person anyway. You're probably looking at something different. And bear in mind, different industries, different timelines and horizons, but it does, generally speaking, that's where we're looking at. And then the last question, and then I'll kind of start digging in, and I have one more poll after that for you guys. So the last one, how much of the company are you, I don't know if people can see that. Hold on. It's not giving me there we go. No, that's timeline. There we go. How much equity are you hoping to own by the time you exit? Wow. I love the participation, I have to say. So I'm super excited once we get more to the questions. So maybe I'll try to speed through some of this so we can dig into what you guys are looking to understand more about. Interesting. Great. So I'll end it here so we can just keep going. But again, kind of showing me some really interesting things about like how everyone is looking at this. So typically speaking, if we're talking about venture capital, on the high end, you're probably likely to see founders exiting, the founding team exiting something between the 10 and 25% range, like most of you, I think, are expecting. Anything more than that, it's pretty rare. You're talking about $100 million businesses. So if we're talking about that, you owning 50% of that would be probably pretty rare. Most people don't think about the idea that like, as you begin to take on diluted funding, you're going to end up giving away a lot of equity. Even just like the first round, you'll typically see founders giving away about 15 to 20% of their business to VC investors. That already eliminates a lot of people in this. So if you are trying to build something and hold on to the company, it's something I think very important to consider, that you are going to lose a lot of control. You're going to lose a lot of equity, and those two are different things. Control meaning like the power and the ability to like actually make decisions about your business. You're going to have a board. You're going to have people who can basically vote other directions. And so considering all of that is really important when we talk about fundraising and like understanding what your business is and what the investor's business is. So I'm going to go ahead and dig in now. So understanding your business here. When we again, like I said, it's like, what are you building? Understanding that from the level of like, am I building a B2B SaaS company? Is this a CPG product? Is this sustainable hardware? There's a wide variety of things you could be building, but understanding that is very important to understanding not only like your timeline and your trajectory, but also understanding your market, how large you can get, how many competitors you have in that market. So if you have a ton of competitors that, you know, we're talking, it could be let's say it's $1 billion market, but you have a lot of competitors in the space. If you can only capture 10% of that, what that really is looking like is more like a $100 million market, which again is still fine, but you need to understand what you're building and what is really like the size and scale of that. So that kind of leads into this next question: how scalable is it? How big is it reasonably going to get? And a lot of times, like investors, that's why it's so important in your deck to have some of those details. They don't always trust what you're writing, so don't worry that it might be wrong. I think a lot of people want to evaluate that for themselves, but they do take it into consideration just to see kind of what you're thinking about. How large is this business really going to get? And how far are you going to take it as the founder? And then, like I said, it's how big do you want it to be? Because ultimately it's up to you. In the same way that accepting that capital or not is up to you, it's the same thing. You get to decide, how big do you want this business to be? Do you want it to just be what we like to call lifestyle businesses, where you can own 50-60% of the business and you're making $5 million in annual revenue? That's phenomenal. That's great. You're making a ton of money. But it becomes a question, and you've probably heard this analogy, is like, what is it? It's like, do you want a grape or do you want a piece of a watermelon? The watermelon's a lot bigger. You could get more out of it. If you have 5% of $1 billion, that's a lot more than 50% of $10 million. And then I think the last piece there, you need to have some kind of consideration of like what value you're looking for outside of just purely a capital allocation, because then that's when you start to really weigh sort of the risks associated with that capital, as well as like what the advantages and disadvantages are. And so that leads me into this final question. Why are you guys talking to investors? What are you really going there for? What are you interested in? Maybe it's just capital. Maybe it's something else. I'm actually very curious to know this one, to be honest with you, and test some of the more of the sentiment.
Also, just to clarify, when you say connect me to customers, could that also be like connect me to partners as well?
Yeah, I would say
or is that
so.
more of an
I would say so.
operational? Okay, got it.
I would say partners too. It's kind of like just walking you into the room to speak to someone that can ultimately like help drive the business forward, whether that's paying directly for the service or setting you up in a situation to make a lot more money.
Got it.
So this is pretty great. So this one, I mean, I don't necessarily have feedback, too much feedback for, and the reason for that is because a lot of this is, it can vary. But we'll get into like more about these like particular forms of capital and where a lot of them typically kind of sit on the spectrum of operational versus just purely capital allocation. But I think the majority of you are hitting on like the two key areas, that one is the operational side and the other is the capital allocation side that you should really be thinking about. And investors oftentimes very much so fit into those categories. Some really just, it's a bad way of saying it, but some like to just spray and pray, where they're like, I'm going to make a ton of investments. I know that some of them are going to fail. I know that some of them are even competitive against each other. I don't really care. I just know that one of them is going to win and it's going to return my fund. While you have other investors who are like, I only make 3 deals a year. I really dig into these companies, and I want to be the first call you make when something goes wrong, so that I can really support and help you with your go-to-market strategy. I can work with you on the product development. I've even heard of different funds who provide engineering talent to teams specifically so that they can help build out their like hardware products. So it fully varies and runs like the full spectrum. It's on you to kind of do that research and due diligence when people want to talk to you and when you want to talk to them, to make sure that no one's time is ultimately wasted. And now I'm going to go to the next slide. So understanding your investor, types of funds and the thesis mandates. So a lot of times entrepreneurs will go to, they'll see, oh, this person invests in ed tech. Great. But that isn't usually just like the only thing that is part of their mandate and part of their thesis. So you have to dig a lot deeper. Typically speaking, you'll see funds that they only invest in certain stages, whether that be pre-seed, seed, Series A, Series B, all the way to Series E. It all just really depends. And these are things you have to understand. On top of that, they also have mandates. And so some of these kind of cross over. So apologies if I'm kind of like hopping around the slide a bit, but in terms of like the mandates, certain funds discuss with their investors that, they need to ideally own 15 to 20% of the business by the time it exits. That's just their thing. So what they'll do is they'll invest money and they'll also follow on. It gives you a certain lens into like how they're thinking about these deals. On top of that, some of the mandates can be geographical. So maybe they don't invest in Chicago, they only invest in New York, or they only invest in Florida-based companies. That's, again, something that you have to understand and look into so that when you're reaching out to them, a lot of them will just say that, but for the most part, I would imagine some of them will just ignore you because you didn't do your research. So why are you wasting their time? Again, going into this whole like operators versus capital allocators kind of conversation, it's something that you just need to pay attention to, because I think some people go in expecting and just saying like, I just want the money. I can do this all myself. But not all investors are really into that. Some of them are investing in you because they feel that they can provide outsized value to help you grow the business. Maybe they don't want to just give you $5 million and let you run away with it. They may want to give you $2 million, but help introduce you to customers. So these are things and little nuances to know and understand when you're having that conversation. And also, I had kind of changed this slide around. One of the last points I would say is like, really, if you don't know, ask. Do your research and ask. If you are able to get a meeting and you have a compelling business that you got that intro and you're unsure about like what this looks like or what their goals are, ask the question. Do you follow on invest? Do you typically lead rounds? What is your process for investing? These are all just like smart questions to be asking investors and showing them ultimately that like they're not the kid in the candy store, rather you are. And I think that's my next slide, which is you're the kid in the candy store. Investors, as I said at the beginning, they're here to make money ultimately. Whether I would even argue that even the ones that say like, we're super impact focused or we're interested in certain initiatives or what have you, at the end of the day, they received investment to make money. And so they're here to make money, and they need to deploy that capital as well. I mean, again, going into that kind of fund structure and mandates, you run it like, I think part of the thing that a lot of people are afraid of is like, oh, investors aren't investing, they're not deploying capital. Part of this is a situation where they kind of have to at some point, because they're holding on to people's cash, and if they're not making money off of it, then those people are going to go invest somewhere else. And that's just kind of the way that this works. I see someone has their hand raised. I don't know if I should be pausing.
So if you have a question, do you want to pause for questions or wait till the end, Naji? Because a lot of people are submitting through Q&A, and I'm not sure who admin is.
Okay. Well, let me just keep running through it, and then because I'm almost done pretty much, and I'll get off my soapbox. So talking about the types of capital, so going back to the whole candy store analogy, here's your candy to choose from. So when we're talking about earlier stage, most people like to think about angels. That could be high net worth individuals. It could be friends and family. It could even be incubators, which are sometimes dilutive, sometimes non-dilutive. But these are some other ways that you can get capital. I would say a lot of times, just kind of running through some of the like general characteristics of these ones, like high net worth individuals, you're typically looking for that. You want someone, this is kind of like the passion section that I would say is like where people are investing more in a dream. And they're also investing probably in areas that they kind of understand, or at the very least are super excited about. So this is when you see, like I see a lot of health tech companies with doctors on their cap tables. Perfect example of a high net worth individual who had 250K that they could invest into a business, and that allowed the company to get off the ground. Friends and family, I think that one's a little bit tricky, especially depending on who you are and who you know, but it's just another form of angel investment that's usually a little bit less intense or less formal in a sense. So you can, write these safes, and people aren't necessarily inherently saying like, I want this money back within 5 years. It's something more where they're potentially just like interested in investing in you, which is, I think, probably one of the more exciting forms of investment. In terms of like the private equity section. So this is where we're talking about more formalized types of capital. And so that includes like accelerators like Techstars, for example, family offices, venture capital funds. I also threw in there CVCs because those can be a little bit different as well. And then private equity. And so all of these come with different kinds of layers and tiers. I would say accelerators, family offices, typically, accelerators definitely lean to more of the earlier stages. Family offices can kind of run the full gamut. They can invest at very early stages as well as very late stages. Typically, they're a little bit more, I guess, like mission aligned or focused in some sense. They're not typically just like agnostic. As far as like the VCs, that can again run the full gamut, early stage to late stage. I would say it edges a little bit away from like the very much like idea stage. They typically want to see at least something. They want to see that you're a strong founder, that you have founder market fit, things like that. When we're talking about CVCs, that one kind of ranges. A lot of these, I would say they're usually still at like a growth stage. So we're talking about like Series A, like late Series A and on. And typically what you're seeing from them, they're a little bit more straightforward in terms of like, usually it has something to do with the company or some company initiatives, or potentially like the LPs that they work with. They are looking for ideal products for them to like partner with. So if you're looking more for like partnership routes and things like that, and you're a little bit further along, CVCs can be really great options. Also, you see a lot of times like CVCs are kind of looking at these companies with the mindset that eventually they may acquire them. So that's like a different kind of situation. And then going into like private equity, I would say that's usually a little bit later stage. Typically, they want a lot more control. If you were to like look at some of these charts and breaking down like VC versus private equity, I would say private equity still lends itself to kind of an older model of investing where you're still talking about like obtaining like upwards of 50% of the company just like right off the bat. Yeah, kind of the whole like takeover mentality. And then we have non-dilutive money. And so this is, I think this is like pretty exciting for a lot of people because if you can kind of get into that world, it's pretty lucrative. I've known founders, one specifically based out of Houston, actually, where I think this was back in like 2018, but at the time she had raised upwards of like 2.5 million, and it was purely off of competitions and grants. She had never raised dilutive funding at that point, which was pretty absurd. At least to me at the time. But other forms of that include like debt. So that's like your traditional, just going to a bank, for example. But then you also have things like revenue-based financing. And there are a lot of great institutions that provide revenue-based financing as well, where they're more or less giving you a loan based on what you are doing as a business, like what's your ARR. So I had spoken to a fund recently who they look at companies that are doing 500K in annual revenue, and they'll give you a significant amount of capital. It's also non-dilutive because you're ultimately just like repaying it back as you make revenue, which can be really nice. And that way you get to keep your equity. And then the last area that I think is often overlooked, but I don't want to neglect, what do you call that? Minimize the challenge that it can entail, but revenue, just getting revenue, building a really strong business and having revenue to bring in. That's you investing in yourself. That's you putting money back into the business. I recognize that can often be a challenge, and maybe you need some funding first to like scale up to that, but it is one of the sources of capital. And so we'll kind of end here with just like this last piece about, like I said, it's the big why and telling the story. I think people often want to think, although investors are investing and trying to make money, I think part of the fun and part of the entertainment value is like understanding like why you're doing what you're doing and knowing that you are also going to be the founder to do it. And so telling that narrative in a really strong and compelling way is not only a good way to be like marketing and pitching yourself to investors, but also it shows a lot about how you draw people into the idea, even just as a leader of a company. So can you attract the right kind of talent? Is your passion going to be able to translate itself into kind of reaching for the insurmountable, which building $100 million business from the ground up kind of is that, are you going to be able to climb that mountain? And so really like crafting that story along with just like where the company has been and how you're navigating things is really, really important to this story. And it'll be important for just about any kind of investor of like how you got there, why you're doing what you're doing. I think the only ones that may not really care as much is when you get more into like private equity, where they're like, you built a great business, you can walk away now, we own this and we'll run it for you. But I would say the other areas, it's definitely something that they want to understand and see, but regardless, it's a part of you kind of pitching the business overall. And that's kind of it. Like I said, I'm Naji, and happy to answer any questions you guys might have.
Awesome. Thanks, Naji. So actually we had quite a few questions come in. So if you do have a question, please use the Q&A button at the bottom of your screen. But I'll kick us off with you kind of touched into it a little bit and there with showing your traction and how you're navigating through any murky waters. So I see some questions in here about if you can't show your ROI, what are some ways that you can create a compelling narrative for investors?
We kind of touched on this in one of the other talks before, but I think when you can't explicitly show kind of like income coming in, I think a lot of the good ways to go about like still crafting that narrative is to show that you have a pathway there, whether that be letters of intent, whether that be potential pilots in the pipeline, things like that, that can show that once you are further along, or that, I guess, what's a better way of saying this, that with a little bit of a push, you can get there to being revenue positive or generating some kind of revenue. Or that can show, you can show the investor like, hey, I know at least who my customers are. And with your ability or your experience in this market, we can then take this business somewhere further. I think a lot of investors all like that. That's something that's pretty compelling too. Like, you're really close, but I can make that introduction to this hospital group, or I can walk you in the door for NASA. I think that was like a space tech question. Is like, I can walk you in the door to NASA or get you connected with the Air Force, so that you can then at least get that pilot, get that letter of intent, and execute. That's kind of the way that I would navigate those sorts of conversations when you don't have the ability to get revenue yourself.
Yeah. And I've also seen it too for, when people are applying, I've seen founders show their progress that they've made in the last like 3 months to where they were 6 months ago to where they were a year ago. And it's just really showing that you're building something that people want. And you can do that through, customer surveys. You can also show if people have signed up for a beta test that you're running. So there's a lot of ways that you can do it, in addition to what you're saying. So I think that's a great answer. Thank you. All right. So for a lot of different VCs, and this is from NK, NK said, there's a lot of different VCs that only consider founders that are currently in their network. So what is a good way to get on their radar, or to get on your radar if they're interested in working with you, and they're currently not in your network?
Yeah, that one's tough. I will say that, and I would argue that it's somewhat of an unpopular answer, but I think if it's a compelling company and you have a compelling offer to make, most investors are probably still going to try to talk to you. They may be more likely, they're probably way more likely to do so, and will probably have less of a, what do you call that? Sorry, I'm losing my words, but less inhibition in talking to you if it's coming through a warm intro. But I think a good way to get on their radars in general is still trying to reach out to them, whether that be via email and sending a really awesome, I like to send very short, compelling, and concise emails. There's also, you also have Twitter, like following them on Twitter and engaging with them that way. Reaching out via LinkedIn and trying to get connected, going to events that they speak at and asking really solid questions. These are just ways that you can kind of get your face in front of these people so that they can get to know you. Because ultimately I think like you're hinting at, it is kind of a relationship game. So you do have to kind of navigate it and play it that way. It's not always easy. Some investors lean more towards, I'm only talking to people in my network because I have way too much inbound and I don't have enough attention span, all the way to investors who are very open to just like, hey, set some time on my calendar. I have open office hours. Feel free to, book some time and we can chat. So it kind of runs like the full gamut there. But I think the best ways are like going to events, reaching out via like social media platforms. Also kind of just being persistent, honestly. I know it's kind of like annoying, and as someone who doesn't like to like text people repeatedly with them not responding. I know that pain and fully understand it, but there is something to said about being persistent, but also not being annoying, because that can also be a little bit of a detractor if you're being a little too annoying. So you just kind of have to play that game and that fine line. But ultimately, as well, though, at the end of that day, if this investor is really not responding and not trying to connect, there may be something underlying there that is telling you basically like that's a soft way of saying no, that they're just not interested in this idea or it doesn't really align. I think the other way to navigate some of this, if you really want to get into some of the nitty gritty, is definitely using like an email tracker, so that you can at the very least see if people are like looking at your messages to see if it's something that's even remotely on their radar, whether that be through whether that's like they're forwarding it to someone else and someone else is looking at the deal, et cetera, et cetera. Different avenues to approach.
Yeah. And something else that I also think helps is when you're those concise emails, when you're sending out, let's say like your deck, make sure it's accessible. Like I can't tell you how many times we had people send in and say like, hey, can you check out my deck for me if I'm a good fit for a program? And when I click to open it, I can't even open it. And it's just those tiny details that matter because, one of our old colleagues told me like sometimes people review applications in or decks in 30 seconds, right? So you really have their attention for just that amount of time. So make it count. I can answer the next question because it is about applications. So this question is from Joseph about, since submitting their application, if you've had a lot of traction, can you go back in and edit, and will it change your submission ranking? So there is no submission ranking in the sense of like, if you submit your application later, it doesn't get reviewed by the teams. We review all applications that are submitted into any pipeline. So if you go back in and edit your application at any point, all you have to do is just make sure that you put a timestamp of that. So I would always say put update application and the date. So August 8th, 2023. So that way the teams know what you've added to change your application. We should have a more seamless process soon. So keep an eye out for that. But for right now, if you have any updates that you need to make, you can do that at any point, even after you submit. All right. So Naji, I actually see a lot of questions that I'm going to combine together about solo founders. Can you explain a little bit about what Techstars thinks of solo founders, and if being a solo founder is going to stop them from getting in or being successful even outside of Techstars? What is your viewpoint on that?
Yeah, that's a great question. So I want to take a step back and say I don't want to answer for all of Techstars about how they feel about it, but I can tell you how I personally feel about it. For me, it's not a complete no, but it's not like a red flag, I'll say, but it is a little bit of a yellow flag. Not for what you might think it is. It's not inherently that I'm just like, oh, you're a solo founder, you can't do it. It's more so has to do, at least for program, it more so has to do with the workload and the ability to actually still run your business. And I think that can be really challenging and taxing. So if you ways around that, at least for me, things that I'll be looking for when I see a solo founder is oftentimes I'm looking at well, what's the makeup of the rest of the team? Do you have someone? So if you're the CEO and you handle the sales and you're going to be the one in program, do you have a CTO? Or if it's not a CTO, do you have a head of tech that is going to be the main person doing all of that kind of work? Do you have the support in place that is high enough level, whether or not they're a founder, but high enough level and responsibility / authority that they can kind of help you with running the business? That's going to be the big piece for me. And typically what we see or what I've noticed with like solo founders is just the workload becomes like really unsustainable at a certain point, and then they're not getting as much value out of program as they'd like, or their business isn't growing in the way that they'd like because they're not fully there paying attention. So I think it's just something to bear in, for me, it's just something to bear in mind and to be a little and cognizant of. But it's, to me, it's the same, it's a very similar vibe as like not having a technical co-founder.
Right.
It's like that, it's not a complete red flag, but depending on what the business is, and if you don't have someone there, that's where it becomes something just to be more hyper aware of, in a sense.
Yeah. And to also make everyone aware as well, like we definitely accept solo founders at Techstars. We typically do see more success with people who have co-founders. And as if you're thinking, oh man, should I even apply? You should always apply, because if you can convey those things that Naji was mentioning as like, hey, we just need to see that you have some support system that's going to help you, whether that's through advisors, mentors, or people that you're planning on hiring. We just want to know that you've thought about that too, of like, okay, these may be some of the gaps that I have, and where I may need to hire in the future very soon. So just some food for thought there. There are a few questions about exiting. So as a startup, do you have to plan on exiting as part of your roadmap? Is it a deterrent for investors if that's not part of your plan?
So I'll try to answer the question, but there's like a follow-up question I would have. It's not, do you have to have the exit plan already in mind? No, not necessarily. I don't think most investors, I don't think are gonna, you could say that it's like that's your plan and what you're thinking, and that's cool to know, but that's not it's something that's kind of like, we're not there yet, how about we get to profitability first before we start talking about like a potential exit. But do I think it's important to be considering, like, yeah, I do think it's something you should be thinking about as like a founder and as a leader, like, where is the potential exit? Like, is it going to be the route of selling it to a larger company? Are you thinking that this might be an IPO? Are you thinking like this will be like a merger? Like, what are you thinking? But more so, it's an exercise in like understanding your market, and like a market analysis kind of exercise, than it is actually knowing what your exit is. And I would additionally say, if you're meaning it in the sense of like, should I be including that in a deck? I would say you don't really need to. I don't think that's going to be very relevant for the investors. I would focus more on some other parts of the business that are going to be way more compelling and exciting for the investors.
Got it. All right. And I think we have time for about 2 more questions, if that's okay.
Yeah, got the hour.
So once you receive funds from an
admin, so again, as I said earlier, there are vastly different types of investors. So it's hard, that's like an impossible question to answer, because some investors are looking at some investors are looking at like I said, they're looking at 3 to 5 year kind of returns. Some investors are looking 5 to 7. Some are looking for 7 plus. So it really just kind of ranges. Some are like, that's not even why they're investing. So like, for example, there's been a recent trend, like a lot of private equity firms like buying up dentist offices. Some of these, like, they're not even looking to necessarily like exit it. They just want it on their like cash flow. They just want it on their bank statement. And so like some of it really just varies. I think to kind of answer your question with another statement, as I said earlier, if you're not clear about what that timeline is, ask, say, hey, what is kind of the life cycle of your fund? When are you hoping to pay back your investors? So when they tell you that, they may say 5 years, they may say 3 years, they may say, oh, this is really patient capital, 10 plus years, like we don't care. It really just depends on the investor and what their mandates are.
Mm-hmm. Okay, great. So this question is kind of a two-parter as well. I'm going to combine it if that's okay, because we have some questions about equity. So the first part is, when you exit, does that mean that you give up all of your equity? Or does that mean that you sold your company? Or if you get to keep a piece of the equity, what percentage does that look like from an exit?
Yeah, so that's a great question. The easiest way to answer that is to say that there are different forms of exiting. Not all are positive as well. Exiting could also just mean the company dies and you didn't go anywhere. Did I just freeze?
Yeah, you.
Oh no. Okay. Oh, I did freeze. Okay. So but like in terms of, I think what you're asking, it's like exit could mean, yes, it could mean like selling the entire company to another company and you're completely cashed out and you have no ownership of that company at that point. But it could also mean you IPO. And then you don't have to sell all your shares when it IPOs. You could hold on to it. A lot of founders, I think, try to like de-risk to some degree, so they'll sell a good portion of it. They'll try to even sell portions of it before they exit or before they IPO, but that would be a way that you could still hold on to some of it. So it'd be like you'd basically become just like a shareholder of that company when it's public. And is it common? I would say in terms of like hedging your bets, it's fairly common to see founders still own like at least a little portion of their company, but especially after like an IPO. But I don't have any like hard statistics on that. This would be kind of just from conversations with people. But no, exit doesn't always mean selling the company. It could mean a wide variety of things. Yeah.
Yeah, I've also seen a situation with a founder where they exited and sold all their shares, but the new ownership actually brought them on to continue as an employee. So they managed an in-house team for them for a few years as part of the agreement. So there's a lot of ways that this can show up. But thanks for that great question. Mm-hmm. All right, so I know we have a few minutes left. Maybe this one is a little bit, I'm going to take it just one last question to end it, but somebody asked about your experience at Fundin. So I don't know if you could talk about that a little bit, but they wanted to know, our team, if you would recommend it as a resource for founders raising capital.
I would let you talk to the team at Fundin. I think it is a useful resource for fundraising. I think it lends itself more so to people who maybe don't have the network or the time to actually like kind of go through the fundraising exercise themselves. I'd done something similar like on my own for a while before working with Fundin. But basically serving as like a consultant to help you through the process and help you get connected to investors. I think it could be a valuable resource. I mean, they'll tell you, I believe they still kind of evaluate companies to make sure that they are qualified enough for them to really be successful working with Fundin, which is also kind of nice from the founder side too, because you get that kind of evaluation. But I think it just depends on what your needs are. I would definitely like talk to them if it's something that you can afford and it's something that you feel like is fairly necessary. Then I mean, it's an option. But there are also like other options of different people who can help you fundraise and things like that.
Awesome. Great. Well, before we wrap up, can you just let everyone on here know about, I know you covered it a little bit at the beginning, but we've had some more people join us throughout the presentation. So can you share again your programs and what kind of startups you're looking for your 2 accelerator programs?
Yeah, absolutely. So again, Naji, I'm the investment associate for Techstars Oakland, powered by JP Morgan, as well as the future of e-commerce, powered by eBay, here at Techstars. So the first program, Oakland, powered by JP Morgan, right now, at least we're focused on on a few different verticals. So it's fairly agnostic, but health tech, climate, ed tech, fintech, and future of work. More the future of work side, more so from the standpoint of like AI powered tools to help you be more efficient with work, things like that. There is a diversity. So we're looking for like the best founders, but we are particularly interested in Black and Latinx founders for that program. As far as the future of commerce powered by eBay program, we're focused more on kind of the infrastructural layer of e-commerce. So think of not simply like innovative marketplaces, because we're not really looking for, but more so the tools that can like help streamline the process of buying and selling online, as well as like empower the businesses and organizations that are doing so from a very like base level layer. So we're talking about kind of like dev tools, we're talking about data visualization and analysis, somewhat marketing and ad tech, things like that. Yeah, I don't know if that helped answer the question, but if you're interested in applying, definitely feel free to reach out, and can definitely help like clarify to see if it may or may not be a good fit.
Yeah, thank you. And so everyone follow Naji's advice from earlier, follow him on LinkedIn, see if he's on Twitter, get him there, because his team also hosts their own events. So in addition to our general Techstars events, so make sure you catch him on LinkedIn. But thanks again. That was super helpful information. I learned a lot from that too. So I really had a good time. And for everyone, here is our meet and greet page as well in the chat. We try to host an event at least once a week. So sign up for the next event if you're interested, but we'll catch you all next time. Have a good one.
Mm-hmm.